what I mean? It's either that or Mexico or Turkey. I think I'll pick Australia. No offense. So anyways, I'm worried that we're over here, right? Yeah, that's good. Aaron, I'm sorry, I missed the question. 1116, is it worth it back to the hourly 5? I think I missed the question, Aaron. Oh, okay. Hi. Hob, send them to me because I have to sign them. And I'll send them back to you. Oh yeah, you guys want to do some yield curve? I'm cool with that. No, you're perfect. You're perfect. You're perfect. Alright, so what do we want to talk about? Where do we want to go with this? I know we had some basic questions, and so we were going to talk about yield curve a little bit yesterday. So let's do some basic discussions here. Yeah, go fly a shark, Kurt. Go buy a clownfish, will you? No, but you make very, very valid points. It just ruins it. It's a buzzkill. But I highly respect everything that you say, just so you know that. All right. A couple of things that we should get out in the open right away. There's a concept in treasuries where price rises. Okay? Price rises. The yield, or the percent return, yield falls. That's the relationship with stocks and bonds. So it's interesting. What does that mean? Well, there's so many different ways of looking at it, and I look at it in sort of a kindergarten level world, because that's me. Hang on, I'm going to need a rock star for this. I'm not sure if my headset will reach. Oh yeah, just alright, so let's say the stock market crashes like it did in 2007, 2008. Okay? By the way, who's into this lesson? Who's the major audience here? Who am I really talking to? Who's interested, like, oh man, we're going to talk about treasuries, bonds, yield curve analysis, etc., etc. A lot of people know this. Okay, good. All right. So when the stock market crashes, folks, what do investors tend to do with their money? Flight to safety, which means liquidate means they buy bonds, right? They get out of a risky asset and they buy something safe. In particular, not necessarily there's lots of different terminology. I'm going to say treasuries, because they're not buying. You could buy corporate bonds and different types of bonds, and some bonds have more risk than others. But if you're buying a government treasury, it's perceived as no risk, or so little risk it's basically no risk. Okay, that's why it's considered safety. Buying a junk bond is not safety, so I'm not going to use the word bond. If I do, it's going to be a 30-year investment into a treasury. So let's just say treasuries, right? And I'm talking primarily T-notes and T-bonds and T-bills. right? Okay. So you get out of your risky stock, stuff that's been making you money, and all of a sudden it's crashing, falling apart. So you're like, all right, cash out. Now you're stuck with all this money. But you don't want to be stuck with money. So you decide you want to lock it away somewhere safe and earn a small return on investment. Okay? But really, you don't care about the return. You care about the safety. You're guaranteed that it will be there. Good. So when the entire planet, though, is doing this, think about the treasury market, which is very, very large and very, very liquid. Okay? It's almost like Forex. It's very large, it's very liquid. Okay? And you can, and it's not just the United States, like Japan, for example, or Germany. Very large, very liquid markets. So if everybody is buying, I want you to imagine an auction. What happens when an item comes up for auction and everybody in the audience starts bidding? Or I don't even have to say everybody. One thing that Kurt tracks a lot is bid to cover ratios and stuff. So if there's a 4-to-1 bid to cover ratio, let's just think about, the first item comes up for order and 4 people are bidding for it. 4 bidders are seriously trying to buy the item. Okay? Price goes up, doesn't it? Because they're bidding for each other. Lots of people want something. Okay? Prices go up. Now, if an item the next item comes up and nobody wants to buy it, there's no buyers in the audience, what happens to price? Nobody, it's crickets. Let's start the bidding at 1,000. 1,000. Gonna get a 1,000. 1,000. 1,000. Okay, 500 then. 500. Let's get the bidding going at 500. $500 for a T-bill. Come on, 500 rounded. $5 company. We're rounded to $500. 500. $500, folks, for 5-year T-notes. Prices come down. All right, but there's two pieces of the equation here. It's not just price. The price is going to be built on supply and demand. The other equation here is yield, that percentage. Let's say you were trying to raise some money. Okay, if you don't borrow some money by the end of the month, you're going to lose your house. So you go to the bank. What's the bank going to charge you? The prime rate plus a spread, right? Anybody? Anybody? Probably 4.5% in the United States, whatever. Okay, but what if the bank won't lend you money? You don't have the traditional credit. Now what? Who do you go to now? Pawn shop, loan shark? Do they charge, will a pawn shop charge you more money or less money than a bank? Yeah, significantly more. So it could be the other way around where you could say, look, I need to borrow money. I'm willing to pay you 5%. And people are like, we know you and stuff, and you're probably good for it, but I don't know, times are tight, and, I'd like to help you, but gee whiz, I really can't. All right, I'll tell you what, I'll give you 7.5%. Oh, really? 7.5%? Yeah, that sounds really good. But, I'm going to kind of really scared about times. I don't really know where we're going to be in a year, so I really appreciate it. I really want to help you. 7.5% is more than fair, but I just can't risk, the possibility that things out of even both of our imaginations happens, and you can't pay me back, and I need the money. So I'm really sorry. I just can't help you. All right, I tell you what, I'll pay you 10%, and I'll pay you back within a year. Oh, okay. Now I'm interested. 10%. I just can't pass it up. And so there could be a bidding war the other way around. Okay? Now keep in mind, guys, this is just how I think of it. I think if we were at Harvard University School of Finance, they would freak out. But this is how I think about it, where you have those that want to buy